Japan's yen has reversed course from the middle of November, strengthening against the US dollar, while other currencies like China's yuan continue to weaken. This raises the possibility of more yen carry trade unwinding. A weak yen lines up with the fundamentals of the global economy, whereas a strong yen, that's Japanese financials doing something about them. And in doing something, that has created ripples all throughout the global financial system. From repo to FX funding, even the stock market was tripped up and more when this unwinding process suddenly became disorderly. But why did it cause a major crash in shares in Japan, plus a sizable decline in US and other global indexes beside it? Are they at risk for something similar? We've got several different questions to investigate, starting with the yen and what's really going on there. If it is a signal for more determined carry trade unwinding, we should understand what all that means. What is the carry trade, or actually carry trades, plural? What caused it to go bad in the first place? Next, if the one carry trade had Japanese souring on US dollar investments, we also need to uncover how all that could lead to a substantial stock market wipeout in early August. How do we get from Japanese investments to a correction in the Dow Jones or the S&P 500? Finally, what are the chances this could all repeat again? If there are vulnerabilities in the system, what are they, and are they still hanging around? So what we see right now is that Japan's yen has been strengthening since around November 13th and 14th. Now, other currencies have done the same thing, like Korea's won, but not nearly to the same extent, while at the same time, other currencies like China's yuan have gotten weaker and weaker. Normally, the yen and the yuan trade pretty close together, which suggests, okay, maybe there's something specific about Japan. Now, a lot of people say, well, that's obviously the Bank of Japan, or the Bank of Japan versus, say, the People's Bank of China. The one, Bank of Japan, is raising rates, while the other, People's Bank of China, is lowering them. We're back to rate differentials. But as we've seen time and time again, rate differentials don't explain the behavior of these various currencies. Certainly wasn't the case in early August. So while we don't know for sure, this is still a short-run reversal, there is a non-trivial chance that the yen continuing to strengthen here is a little bit more than just the Bank of Japan threatening to hike rates in December, or the People's Bank of China grappling with more difficulties in the Chinese economy as they relate to the overall global situation. As it is, the way the yen behaved in that earlier episode is something that we need to keep in mind, starting with really the middle of July. Now, there were signals that things were going in the wrong direction as far as the carry trade was concerned as far back as June into July. But July 11th shows up in a lot of different places. July 11th was the US CPI report that I talked about at the time and have talked about repeatedly because of the marching band full of red flags that were contained within that report. It wasn't just disinflation in US consumer prices. There was too much disinflation that suggested the US economy had stumbled badly. And we'll come back to this because this is going to be a point of contention throughout this video. At the same time, the Japanese government intervened in the currency market on that same day, changing the tactics that they had employed unsuccessfully earlier in the year. Remember, Japan's yen had been falling because the fundamentals of the global economy, rising Eurodollar premium, means that Japan's yen should be weak. But the Japanese government had intervened earlier in the year to try to stem the slide, to no avail, to little effect, because despite what the media says, governments and central banks are actually powerless against the Eurodollar system. So on July 11th, when the US CPI report came out, Japan's yen was already strengthening, going in the opposite direction when the Ministry of Finance in Japan decided that was the time to intervene. Apparently, they were sick of failing at intervening when the yen was falling. Now they were going to piggyback on the yen reversal, and the yen reversal is what really is important here. On July 18th, Reuters reported, unlike past episodes of intervention that typically came in the midst of sharp declines in the yen, the suspected intervention on July 11th, CPI day, came when the dollar was already sliding in reaction to weak US inflation data, and really the implications of that inflation data. This suggests Tokyo attempted to seize the moment when the market's tide was already moving in favor of the yen. Rising prospects of a near-term interest rate cut, no, that's not it, would also allow Japan to argue that further yen falls against the dollar did not reflect fundamentals and justify intervening. And as usual, they always have to make it about some central government or central authority, in this case, a central bank. In other words, everything that happens must be because of some central bank policy somewhere. That's what we're taught to believe. But in this case, the yen carry trade is not about interest rates at all. It's about U.S. recession risk. And the U.S. recession risk that was contained in the CPI report, which was duplicated in markets all over the economy, including interest rates themselves, the flight to safety, heightened demand for safety and liquidity, lower growth and inflation expectations. As that was being priced into various markets, the yen carry trade, the real meat of it, the core of the yen carry trade, was reflecting upon what was contained in it, which was heightened recession risk. Well, what is the carry trade? There's actually a couple different carry trades, but the one that I always focus on, which is the majority of it, the bigger one, is where Japanese financial firms that have very little to no investment opportunity locally, domestically in Japan, take their financial strength, reputation, and connections to the Eurodollar system and buy assets in overseas markets, whether they be US dollar assets or intermediating through US dollar denominations, the Eurodollar system, and buy assets all throughout the global financial system. They want higher yielding but higher risk returns. They can find them in some market somewhere using the US dollar as that reserve vehicle currency. And over the last several years, what the Japanese have been doing is getting yield in US dollar terms by reaching for yield, buying higher risk securities like US junk corporate debts and justifying it as not a big increase in risk because of the perception that the U.S. economy was just fine, that it was heading for a soft landing. Jay Powell kept saying so. So Japanese firms, these real carry traders, these big financial companies, have been buying risky U.S. dollar assets on the idea that they could, first of all, get a little bit better return, but do so for little to no additional risk. And that little to no additional risk, which is the key here, was simply because everyone assumed Jay Powell knew what he was talking about, that economists were right. The U.S. economy would completely avoid recession. That's why all of this popped up in the middle of this year. Because suddenly, as we went through May into June, and especially July, more and more signs of the inflection in the economy that I keep talking about. We saw evidence of it. We see it in the real economy. Companies around the world were saying, hey, something wrong in the United States. In the middle part of the year, culminating in late July, the middle of July into late July, all of these carry traders who own risky investments that are sensitive to U.S. macro considerations suddenly realize maybe they're riskier than they thought they were. So it started really getting disorderly in that middle of July. So the Ministry of Finance piggybacked with an intervention on July 11th, the CPI day. The CPI day seemed to kick off the yen carry trade reverse, and then it just continued from there. More and more recession confirmation came in. We had jolts, jobless claims, and payrolls that final week in July and the first couple days of August that really led to the disorderly unwind. And it actually kept going all the way until the middle of September. So you have the carry traders that are buying US dollar risky assets and other risky assets around the world too that are sensitive to the same macro risk as we're talking about here. But we also have another set of carry trades that we're going to bring in at this moment too. Those are the ones that you hear in the media where you have hedge funds around, especially offshore centers in the Eurodollar system that borrow in yen because they can access yen cheaply, though they still have to swap into US dollars in order to buy assets around the rest of the world, use your reserve currency system. So you have investment funds that are the ones that everybody talks about when they talk about the carry trade that are leveraged positions that are ultra reliant on a whole host of financial considerations and characteristics that are also tied to the main carry trade, which are the Japanese financials. In all of this carry trading stuff and financialization, we need to talk about whether or not that's actually how we want the system to behave down the road. As the Eurodollar system reaches its useful life, the end of its useful life, on December 11th, Jim Rickards and I are going to be looking forward to what might come afterward. Unfortunately, it's not going to be overnight. We're going to discuss what the monetary system could be or maybe even should be. And we have some different ideas about what that means, so this should be a very interesting discussion coming from different perspectives. We're also going to talk about how we might actually get there, so maybe we can avoid some of this volatility and nonsense of carry traders and leverage positions and all of that. Like I said, join us on Wednesday, December 11th. There's a link in the description to sign up for our webinar. I hope to see you all there. The Japanese were content to buy AAA rated, the top of the tier, or really the bottom of the big tranches, the senior pieces, which were AAA rated and offered a little bit more return, but complete, at least what was thought to be, complete safety. But as they've been forced to reach for more and more yield, they've had to take on more and more risk to do so. So no longer just AAA rated, now AA rated, some single A rated, and almost certainly less than that, less quality instruments beyond just the top tier. That's sensitive to the economic risks in the US. So while they're doing that, that led to the vulnerability that starts all of the trigger. The trigger is US recession risk suddenly appears to rise and rise substantially and significantly. That leads to the carry traders, the big financial firms, lightening up those positions, which then started the avalanche. To describe this avalanche, we're going to turn to the Bank for International Settlements, or BIS, in a report from August 27th. They're going to focus on what most mainstream sources consider the carry traders, the investment funds offshore, these highly leveraged positions that are sensitive to, well, here's what the BIS said. The turbulence in early August then followed in the wake of seemingly minor news. According to the BIS, it was minor news. After what was perceived as a hawkish hike by the Bank of Japan and a more cautious approach to rate cuts by the Federal Reserve, investors coalesced around a somewhat disappointing U.S. labor market data release on August 2nd, which was not just the payroll report, which was weak, but also the unemployment rate. Investors appeared to reassess the likelihood of a potential recession, which is a big deal. The BIS is downplaying it here, with some perceiving the prevailing policy stance as too tight. It doesn't matter about the Fed. In fact, the news could hardly be taken as an unequivocal sign of a deteriorating outlook, let alone a looming recession. Yet, markets had become hypersensitive to any signs of a change in growth momentum and in the associated monetary policy outlook. So they're downplaying the recession risk, yet they get right the fact that the hypersensitivity is when you are highly leveraged and you're in a position where you have assets that are funded in, say, for example, repo, and you know those assets, these CLOs or other risky assets in other denominations, are subject to serious deterioration, not just in terms of prices, but also liquidity characteristics that imperil your funding paradigm and your funding transactions. You're going to be hypersensitive to changes in risk. And it wasn't just a minor news report, the payroll report back in July. The entire world reacted to it and said, what the hell's going on here? And it wasn't just the payroll report either. As I've said, those who are paying attention and not just getting their news from Jay Powell realized that the U.S. economy was already heading in the wrong direction long before we got to July and August. In many ways, what happened in early August was a confirmation that the risk, at the very least, were far greater than people like the BIS report, the authors of the BIS report here, would ever admit. So how does that get to the stock market, though? Well, back to the BIS. The related spike in VIX, this is all about volatility, perceived volatility, implied volatility, calculated volatility. So the spike in VIX, which started from the spike in credit spreads that were unleashed by the disorderly selling of these illiquid CLOs, led to a spike in credit spreads, and there is a very tight correlation between credit spreads and the VIX. So the BIS says the spike in the VIX was associated with immediate deleveraging pressures. Upon the initial rise in volatility triggered by the other carry trade, market participants faced increased pressure to cover their leverage positions through outright sales to meet margin calls or purchases of options in VIX futures, thereby further amplifying the rise in the VIX and the size of the volatility shock. The resulting spike in the VIX far exceeded what should have been, they use that term should, and I don't know they should, have been expected based on the historical relationship between the VIX and S&P 500 returns. As carry strategies, as they're talking about the other carry trade, tend to generate small but consistent returns at times of market calm, but quickly generate steep losses as turbulence erupts, they are often portrayed as, quote, picking up nickels in front of a steamroller. A well-established pattern is that spikes in volatility go hand in hand with deleveraging pressures and the unwinding of currency carry trades. There is also evidence that U.S. equity volatility has become closely intertwined with currency carry returns. This common exposure is due to the fact that many equity option strategies entail implicit bets on volatility being contained, akin to currency carry trades. Indeed, the market dynamics of August 5th fit with these historic patterns. So what you have is essentially a classic volatility shock, but one that is triggered by, the BIS doesn't really get into this, they downplayed the recession risk, but that's where it came from. So you have these Japanese firms that are highly exposed to these macro-sensitive, liquidity-sensitive, risky junk assets, CLOs and the like. Suddenly they're faced with one after another report that suggests the U.S. economy is increasingly looking like it's heading toward a recession. Come late July and early August, they decide we got to get out of these positions rather than risk being stuck with them. There isn't a whole lot of depth to those markets at those times. It leads to an outsized response in credit spreads, which then triggers a volatility spike, which then leads to unwinding of positions all throughout the financial system because nobody was prepared for what was ultimately a reaction to rising U.S. recession risk. So the real carry traders, the Japanese financial firms, they're negative the U.S. economy. And the more that they unwind their positions, the more they're telling you we're not going to stick around to see if the U.S. does fall into recession or not. The more it looks like there's a risk for that, the more they unwind their positions. I mentioned before, Mizuho, their chief global investment guy said that, yes, we think that the marketplace is underpricing recession risk in the U.S., and we're continuing to rotate out of risky securities and into U.S. Treasuries. Now, some of the carry traders, the big real carry traders, they repatriate their funds. For if you have a carry trade position in a foreign denomination outside of the U.S. dollar, which means that you've intermediated through the U.S. dollar into some other denomination, you might take those proceeds as you unwind those positions and repatriate them back to Japan, leading to a strengthening yen. As you unwind carry trades and repatriate the funds, the yen rises in exchange value. And that leads to the question, is that what we're seeing in the yen over the last couple of weeks? And if it is, then does that raise the risk of certainly more recession risk being priced into the marketplace, at least in these deep fundamental places? Is there more recession risk than the other markets are anticipating? And is there potentially another possible volatility shock out there? And the answer is, of course, yes. In many ways, because of the fact that, like the BIS, there is hardly any, at least in riskier markets like stocks, appreciation for the circumstances the U.S. economy finds itself in. It's far weaker than is being anticipated and appreciated by market participants in stocks and other places. Bond markets, not so much. As I talked about in yesterday's video, the fundamentals of the global economy, and U.S. included in it, look increasingly dark and ugly. You see that in copper to gold, bond rates that continue to go down, all of that. So stock market is out there thinking everything's just fine, highly leveraged, sensitive to volatility that is itself tied back to macroeconomic risk. So what we're really talking about here is not that this is happening. We know that it's happening, but that as it's happening, it leads to, like in the middle of July, another period where it becomes more and more potentially disorderly, because then that leads to the volatility shock and all of the related consequences. And a sharp rise in the yen would be that signal. We aren't there yet. We see the yen reversing, which could be for a couple other reasons, but the yen is at least going up, which raises the possibility, and all of these vulnerabilities remain. So to answer the questions that we started this video with, the yen carry trade continues to reverse. There is a small nascent signal that it may be amplifying and becoming more of an issue here in November heading toward December. And of course, the vulnerabilities remain in the stock market to a volatility shock, especially of this kind that goes back to U.S. recession risk. And of course, a related question to everything I just talked about is the U.S. Treasury market sell-off. Is that over with? That's something I talked about in the video link below. And yes, all of these things are indeed related. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time. Take care.